Here's a shocking reality check. While the U.S. advertising market is taking a hit, Spanish-language media powerhouse TelevisaUnivision is quietly rewriting the rules of the game. But here's where it gets controversial. Despite an 11% plunge in U.S. ad revenue, the company is not just surviving, it's thriving, thanks to a strategic pivot that's turning heads across the industry. So, how are they pulling this off? Let's dive in. TelevisaUnivision recently unveiled its third-quarter earnings, showcasing a remarkable rise in adjusted profitability. The secret sauce? A booming streaming business and savvy cost-cutting measures that are paying dividends. Yet the story isn't all sunshine and rainbows. U.S. revenue dipped 2% to $831.3 million, largely due to that double-digit ad revenue decline. And this is the part most people miss. Subscription and licensing revenue soared by 11%. But because it's a smaller slice of the pie in dollar terms, it couldn't fully offset the ad losses. Interestingly, if you strip out political ads, U.S. revenue would have held steady, raising questions about the sustainability of ad-dependent models in today's fragmented media landscape. The ad slump in the U.S., which dropped to $428.2 million, 8% when excluding political ads, was overshadowed by the explosive growth in direct-to-consumer DTC streaming. However, this growth was counterbalanced by a weakening linear TV market, a trend that's sparking debates about the future of traditional broadcasting. Meanwhile, in Mexico, the story is brighter. Advertising revenue climbed 3% to $327 million, fueled by the same DTC surge. Subscription and licensing revenue hit $493 million, a 3% increase, thanks to the premium tier of ViX and higher content licensing deals. But there's a wrinkle. Linear subscription declines in Mexico, tied to a key distribution partner's renewal cycle, partially offset this growth. Excluding this cycle, Mexico's revenue actually grew by 5%, while the U.S. saw an impressive 11% jump to $388 million. Here's the bold prediction. ViX is poised to become the fastest-growing subscription streaming service in the Americas in 2025, according to Ampere Analysis. This isn't just a win for TelevisaUnivision. It's a seismic shift in how Spanish-language content is consumed globally. The company first turned a profit in streaming back in Q3 2024, and now it's doubling down on this strategy. Overall, third-quarter revenue dipped 3% to $1.3 billion, 1% when excluding political ads, with Mexico's revenue also down 3%. However, operating expenses shrank by 8% to $804.0 million, showcasing the company's disciplined financial management. Operating income landed at $265 million, down from $419 million the previous year. But that earlier figure was inflated by the sale of non-core assets. Excluding that one-time gain, operating income actually rose by 3%. Adjusted OIBDA, operating income before depreciation and amortization, climbed 9% to $467 million, driven by the relentless growth of DTC profitability and the ongoing benefits of cost-cutting initiatives launched in late 2024. While the exact size of the DTC profit remains under wraps, it's clear this segment is a cornerstone of TelevisaUnivision's future. CEO Daniel Alegre summed it up perfectly. Our third-quarter results demonstrate the disciplined execution of our reimagined content strategy and the continued momentum of ViX as a key growth engine. But here's the bigger question. Can TelevisaUnivision's success in streaming and cost efficiency truly offset the decline in traditional ad revenue? And what does this mean for the broader media industry? What's your take? Do you think the strategy is sustainable? Or is it just a temporary band-aid? Let's debate in the comments.